The best companies, the best deals are bought, not sold. It's always better to sell from a position of strength, align yourself with the likely buyers initially. Many times your best customers or resellers or partners are oftentimes vertically integrating the best buyers.
Welcome to Tech Startup Elev8or podcast. I'm your host, EdTech, exited software founder and CEO of Elev8or Lab. Our podcast is all about elevating you and your startup. And of course, we bring founders, experts, investors, and great people to inspire you, to learn from, and grow together with. So today, I have a great friend and someone who actually helped me sell my own company, Chris Nyren with me. Hi, Chris. Welcome to the pod.
Hi, thank you so much for letting me join.
Chris had a long career building up to his own practice in investment banking and supporting founders. So I'll let Chris introduce himself and tell you a little bit about his journey so you know how much he's done that led to what he's doing now to support founders. And then I have a special story for you to share that connects Chris and me.
I think I know what story that's going to be. So a little bit embarrassing for me, actually, but I think fun too. So I guess my career is now 24 years. It's helpful when you start in 2000. I started during the tech bubble era, working investment banking, Credit Suisse First Boston at the time. Randomly got thrown onto a team working with education and business services companies, not knowing education was even a sector, a for-profit sector. That was, of course, during the dot-com era, so there was a fair amount of EdTech. I remember overnighting pitch books about some EdTech startup to Michael Milken's house and, whatever. But I was a baby analyst, so I don't want to over-exaggerate it. And as the broader tech industry imploded and brought EdTech with it, my work staying within the space ended up more with publishers or for-profit career colleges. During much of the early 2000s, that really was the extent of the education sector. I got my MBA at Wharton School of Business. While there, one of the many internships I did was with LLR Partners, which focuses on education, did a beauty school buyout roll-up. But post-graduation, I rejoined one of the partners from that old Credit Suisse team who became CEO of Apollo Education Group. We own the University of Phoenix. Again, continuing that theme of the for-profit career colleges. They were also EdTech, certainly being that, they had 500,000 students online, massive data centers and investments. I think around the time I joined, I remember running this data once. Maybe it was even the year I joined, but I think the University of Phoenix alone represented 1/64 of all online advertising in the U.S. So scary to think about now, especially given, I think, where the business fell short in missing the mark on educational outcomes. And so after 4 years of acquisitions for that business, and we had a joint venture private equity fund with Carlyle, did about $750 million worth of acquisitions. It started changing under regulatory, legislative, public scrutiny, pretty rapidly ceased becoming a fun place to work. And I realized I had this passion for education, maybe more outcomes-oriented education, but I had to figure out how is it that I could align my work and to be honest, my salary expectations as a Wharton MBA type with the initial green shoots of emerging EdTech startups, especially those that were more outcomes aligned. And again, this is 2010, I guess, at that point. It helped that around that time, Silicon Valley started to rediscover the space. Some of that, I think, that in 2009 and 10, there was a bunch of exits of largely bootstrapped, family office founded education companies, EdTech companies, 9-figure exits. And I think that started to bring capital, Silicon Valley type capital back to the space. But yeah, there was no startup that could hire a Wharton alum for an MBA corp dev job, investing job. And so I had to create my own. Sold my place so I'd have some capital, made a dozen seed stage investments, and I found any conference at all relevant to education, created my own conference, had my own meetup network with 5 chapters across the country. Would go to aligned with things like Startup Weekend EDU, where I helped host and advise EdTech focused hackathons. So spent, half a dozen years just on the road, helping anywhere I could, trying to build this ecosystem. And now 12, 13 years later,
the ecosystem is helping you.
especially opportunities to work with someone like you. Thank you again. But yeah, it was a dramatic change. What I've seen, I literally had, I think it was 2016, fully 3 or 4 of my startups failed. They sort of asked me to step over, help kind of with M&A. Well, a couple did. A couple said, "Hey, I got this." They didn't. They all ended up being acqui-hires with 0 proceeds to investors. Was a bit depressed from that, but the tombstones, if you will, attracted other startups who needed help. And, so lucky in 2017 and 18, one founder in particular, I'll always be thankful, as with you, Jay Goyle, helped ask me to sell Actively Learn. And we ended up getting 3x what he'd hoped for, after a very competitive auction between all of the major ELA reading companies. And that, paid for the prior 10 years of investment losses and otherwise, manyfold over. And so, over the last 5 years, I've definitely understood why so many boutique bankers are much more focused on M&A than angel investing, capital raise. And certainly I've adjusted my focus accordingly. And so that brings us to where we are today. Happy to talk about any of those deals, M&A more broadly. Certainly my experience is colored by EdTech education, but I think a lot of the lessons apply more broadly to tech founders.
Absolutely. Thank you, Chris. And I actually didn't know a lot of those aspects in terms of how much you've invested in building that ecosystem and building that network. And I think one thing that just blew me away, right? And as I was interviewing different bankers, I certainly talked to a lot of larger firms that have many people, analysts, a whole-blown strategy team, M&A team, and what have you. And they were connected, but you were as connected or not, if not more, right? And so that actually really blew me away. So I really want to talk about not M&A first, but how do you build those relationships? What do you do? Do you follow up with people? Do you have a personal CRM? How does that happen?
Yeah, I even up to now, as I'm getting a bit older, I still rely upon the CRM, the Rolodex in my brain. Of course, LinkedIn, of course. But, you see so many people pushing whatever deal CRM, or maybe you can just use, you could maybe just use Salesforce or Pipedrive, whatever you use for CRM. I think you can, but I try to keep it more organic. I also previously accidentally, I think I lost it, but I used to have a pretty good blog that I think was well read by CEOs and investors, focused on education innovation. And I took certainly now 24 years, but even back then, 15 years of perspective on the space, which was quite rare as there was so much new capital, new talent coming to the space in 2010, 11, 12. I think that helped, again, creating my own meetup network, 10,000 members across. I created chapters, again, on education innovation, Chicago, Colorado, LA, and then found someone in Minneapolis who created one. Basically, I saw this EdTech meetup in SF, and when I happened to be there, was amazed at some of the founders I got to meet just at some bar, and then realized, why don't we have this more? And there was a very successful one in New York too. I think, especially back going to all those conferences, founders, whether I was an investor or just friends, would kind of just ask me to just hey, keep me in mind over the next 2 days. And I would, people kind of described it as this human LinkedIn, would realize, what this person's building, what they're looking for next. I'd see somebody over by the coffee machine, and I just sort of grab them and connect them. And I think so much of what I did over those first 5-6 years was for the ecosystem. Tom Vander Ark literally, he called me the Johnny Appleseed of EdTech back then, which I, really appreciated, but was doing so much just for the industry, for the ecosystem, for founders. Never, and again, I wasn't pushing my M&A services, so I didn't have to make that crass commercial kind of appeal at the end of it. It was more trying to support my startup investments, and I'd harbored this ambition at some point to have a small fund, which my track record probably didn't support. But yeah, I think it was just it helped being tireless, being single, being able to just live on the road. But even I think now, certainly the last 5 years, I don't have that meetup network. I really. Be honest, I largely just attend one EdTech conference a year in April at ASU GSV. So I'm sure to some extent it's that those early years of paying it forward, of organizing, of connecting in person or online people, never asking for a favor back for making an introduction, just having to have built up years of domain knowledge when so many people were new coming to the space. I think now that maybe I'm kind of drawing upon that reserve, maybe some of that karma too. But I do think also there's something now today about just maybe I'm also just maybe working. What's the phrase? Working smarter, not harder, or working. I think you get my point.
Yeah. But I think, Chris, you said something really, really important. And I think a lot of people really overlook that, right? You give first, right? You start by giving. And ideally, it comes from a good place, right? It comes from a place where you're not counting the gifts and saying, okay, where is my comeback, right? Where is going to all come? And I think that certainly, I don't know, again, what you believe in, but, higher powers, karma, whatnot, that I think certainly counts. But it also counts because there is a simple rule of reciprocity, and it doesn't work always, but it exists, right? And I think that's such an overlooked skill, if you will, or desire to just be helpful, right? And it's really funny you talk about it because I, now getting into this role of supporting founders, I find myself doing that all the time, or even before as a founder, just didn't meet as many different founders, right? I was sort of focused on building my own business, but it's certainly, I think, very organic. And I think that's really the only way forward when you add value from grabbing people virtually or in person, right, in making those introductions. So it certainly worked wonders for your connections. And I think just proves one more time that it's a great strategy. So now on to the story. So I got introduced to Chris by a fellow Wharton grad who knew him back from those Wharton days. I emailed Chris as early stage founder. I think I was just getting started. Maybe it was back 2018 or so. And I told Chris about my wonderful startup and how we were growing ClassTag and getting first traction and whatnot. And then Chris responded to me saying actually things that were absolutely true, I'm sure, right? But, and as a founder, perhaps it was not the first email of that sort that I received. Okay. So
that makes it feel a little better. Makes it feel a little better. And sorry, let me just interrupt. Again, This is the context. This is 2017 or 18, where I'm doing anything I can for free. Karma, I definitely believe in karma, and and I'll do anything. I'll meet people because I just had so much particular off experience with
that space.
I don't think I even offered to do a call with you. I'm so sorry.
No. He responded to me and saying, "Hey, this is the short version is this is a graveyard of companies, and kind of if you don't have anything better to do this, but maybe spend your time elsewhere." Right. And I'm actually proud of my response back to you because I was very polite and I said, "Listen, I really appreciate this. I know where you're coming from, and it will give me great joy for you to watch my success or something like that.
And of course, you proved me wrong. The parent-teacher communication app was a graveyard. It was an obvious idea. Sounds even more harsh, but it was an idea with such obvious extension to people from Silicon Valley, right? It's just, I mean, just think about Remind 101, right? And it was, hey, how about Facebook Messenger for, what? So you had a lot of, and with that well-capitalized entry and plenty of all over the country that had this idea. It sort of reminds me still to this day, whenever I get a financial literacy for kids game, I'm just like, I'm sorry, this is one I will not do a call with. There's 20 years of history of these. So I'm so sorry for being a bit rude. At least I kind of gave you, I think.
No, but I mean, that's what makes it so fun, right? Now.
I give you a list of some of the companies I'd seen and for whatever they're worth. But yeah, you absolutely proved me wrong. So all the more credit to succeed in a space with so many casualties.
And, I heard it a lot, right? I met my early investors that I met. I still remember, I think Brian Cohen, who was leading New York Angels at the time. I met him and he said, listen, you seem like a lovely founder. You're so driven. You really want this to be successful, but this is a graveyard. Run, right? And so when I got your message, I was like, whatever, I've heard that before. I'm going, right? But I think it is an important point about resilience, right? At the end of the day, if you're building or if you think that you are building a company and the whole world is there elevating you, it's just a la la land. It doesn't happen.
Yes. Yeah. But again, this is the context of K-12 EdTech, which I'm sure you met with a lot of general tech angels. And they were like, "Oh, K-12 EdTech? No, I don't do that.
I'm not going to touch it." Yeah.
That was half of what I did, So of course I want to meet every K-12 EdTech, but the parent-teacher communication app, I can't, to anyone watching this that is not fully immersed, there was just so many failed startups in that space. The difficulty of getting parents to pay attention, let alone pay money. The number of kind of freemium, free Silicon Valley startups that had capital that were trying to do this, just the number of people that had the idea. So yeah, again, just incredible that you not only built it, but you built it off of multiple different revenue models, including, ways of generating revenue that are rarely done in education. What a surprise when you came back to me last year saying like, hey, actually, when you came back to me, it wasn't like you remembered. We were reintroduced again by another, which again just speaks to the power of networks. It wasn't that you said like, hey, I have this old email where you insulted my startup.
From this nasty guy, let me go back to you.
Right. I actually, after we were reintroduced by someone, I was like, I remember this name, and I searched in my email history and I found my disparaging email to you, and I was like pretty embarrassed. I was like, oh, I hope she doesn't see this because I really want to have a chance to advise her now in the sale.
No, but what won me over is you were very transparent about this, right? You actually brought it up yourself, right? And I think
right.
In a lot of ways, I think being raw and unfiltered and being you is so rare in a lot of business circles that people, I think, should appreciate it more. And certainly I did, right? Because you were not trying to say, hey, I wasn't really kind of not nice to you. Like, you brought it up. And I was like, wow, like, I can expect him to bring up other news to me.
That again, that Jake, having the chance to work with Jake on the sale of Actively Learn is the same thing where he came to me and I remember, and it was right after, on the heels of getting so many of my own personal investments acqui-hired for nothing. I tried to talk him out of it. I said, look, you're growing 20% a year. You haven't really raised much. Just keep growing. What else are you going to do? Like, go get a job at Microsoft or something? He was in Seattle. And he's like, what? Like, I used to work for Satya. Like, I could go do that anytime I want. And, but I think he liked that I was not trying to sell him. And I think that reflects the origin of my practice, my firm, whatever you want to call it, where I was trying to be an investor, not a M&A huckster. And so I think it allows me to differentiate and hopefully give a little bit more unvarnished advice to the founder. And then also, I think maybe when it comes to negotiating with buyers, I think people, again, having been in the space for so long, having domain knowledge, but also maybe coming off a bit more authentic allows maybe buyers to kind of believe when I say we have a counterbid or otherwise. So.
Right. Awesome. Well, let's dive into M&A. Maybe we save the graveyard of those early investors for later in the conversations. But let's talk about M&A, right? So obviously, many startup founders want an exit. So can you just talk me through kind of the process, when folks should start thinking about it? When do they actually make a decision that they need to exit, right? Meaning if they raise funding, are there other ways forward? Sort of talk about kind of overarching kind of exit strategy, exit options.
Yeah, I think when I used to be more focused on investing, and this thanks to the chance to work on some amazing M&A, sell side success over the last year, I finally made some new investments over the last year after a few years sitting out, especially around the pandemic and a boom era. But I used to tell founders that I invested in, they'd ask me, when should I start raising the next round? And I said, you haven't already? Maybe you have a couple months after closing your round to kind of just digest and breathe. But you're kind of always raising the next round. To some extent, you're kind of always selling. It's the same probably in K-12 EdTech. When are you selling to school districts? You're not just waiting, 3 months before back to school. You're always building those relationships and proactively selling. So if you do that on the commercial side of your business, you should certainly be doing on the strategic side too. The best time, the best companies, the best deals are bought, not sold. The best time to sell, raise capital is when you don't want to, you don't need to. Phenomenal example of this, a deal that just closed 3 weeks ago. The buyer has not announced it yet, so I don't want to break any news.
We can talk in generalities.
Yes, it's one of the big publishers, and the founder knew that he was a former investor, so he didn't want to sell. He wasn't looking to sell, but it's such a hot area, high school aged, career technical sort of alternative to college, that one of the big publishers came to him and said, hey, we identified this as something we want to build, buy versus build. Could we just commit? And he said, no, look, I've just finally built on my curriculum. I'm not looking to sell. And this was, as part of being a very lean company, he really focused all his efforts on building content and differentiated content and then aligning with resellers, publishers. And so all the publishers knew him. And when they were realizing this country needs to send more of its high schoolers to work, not to necessarily college. And this was such a growing trend and something that foundations, NGOs, school districts are talking about. One in particular came to him. And so that prompted a process. And in the end, it was not even that publisher. It was there's only 4 K-12 publishers, so you can start to guess. But it was another 2 that were bidding against each other, just to a level that the founder never would have imagined. And, again, so I think, again, it's always better to sell from a position of strength, to align yourself with the likely buyers initially. Many times, your best customers or resellers or partners are oftentimes vertically integrating, the best buyers. I think you should always be planning. You should always be building those relationships. And I think in the end, again, the best deals are bought versus sold. That doesn't mean you don't do a process. That doesn't mean you don't turn over every rock possible. It so happened, of course, with your business that the buyer was one that knew you well. But I think of the other 2 deals, I closed 4 M&A sell-side assignments this past year, and then had one of my old original portfolio companies finally sell, all in K-12, which is interesting. But the other 2 we had to call on 100 different K-12 parties to find that one that had a specific gap in their product development roadmap where that small target fit and would allow them to accelerate, buy versus build, et cetera, et cetera. But again, it doesn't mean you don't do a fulsome process, but getting to know product people, getting to know operators at the big obvious acquirers over time, not being afraid of someone stealing your product, and figuring out how you can leverage, in fact, those bigger players for a more efficient go-to-market. Obviously, the less capital you raise, That means the less dilution. It also means ultimately probably the more buyers can afford you. Again, if you're kind of building a business with an expectation that, hey, I'm probably going to get acquired, versus if you're not harboring the ambition to build another unicorn that's going to go public, that is generally the rare exit example, especially in an industry like K-12. 99% of all exits are M&A rather than IPOs. So I think I don't know. I think that's probably some of the advice I'd give to founders. It's you're always planning. Do nothing is not an option. Partners, resellers, customers even can oftentimes be your highest value buyers. And I think you should fully be planning a year before your actual exit, at least.
And Chris, in terms of business models, right? And you touched on this, as I think ClassTech was quite unique because we did have a sort of a more traditional sort of B2B SaaS model, but we also had a more of a consumer monetization with brand partnership commerce, right? Which a lot of folks didn't quite easily understand, but it did make ClassTech profitable. And actually, it was, I think, quite a creative way to overcome some of the challenges in graveyard. why K-12 is a graveyard. What are you seeing? Is it still all about SaaS, or people are getting tired of SaaS and going into different models?
No, it's all
what
about,
is the wind?
It's all about SaaS. Of course, SaaS is coming to mean something different now. SaaS could be some kind of niche vertical app built on a AI based some LM where you literally can only have 3 employees because everything was leveraging some open AI or other kind of LLM. I think it's about and also SaaS is not strictly software. I mean, you had a non-SaaS piece to your business, the e-commerce. Well, the B2C, obviously there was still SaaS and B2C, but there's a piece of your B2C that was e-commerce or ad supported, which is episodic, lumpy, one time. You're always reselling. But the other piece, your software platform, was certainly definitionally SaaS. The other K-12 EdTech companies I sold last year were all curriculum, but digital curriculum is SaaS. You sell it to a school district, 2-3-year contract, and maybe with automatic renewals thereafter. The product can sell itself if you build a freemium go-to-market, product-led growth. It can sell itself in the middle of the night while you're sleeping. And when I differentiate that with some of the other companies I've been trying to help, I have one that I was hoping we'd have a deal signed so I could maybe speak more to it, but I think we probably need another week here. But it is we'll just call it, even though it's the dirty word now, it's a boot camp, but focused on AI skills. And that a piece of it is asynchronous and self-paced digital curriculum. So probably shares the same characteristics of SaaS in terms of LTV to CACs and, again, recurring revenue and typical gross margins. But there's a piece of that business that's also synchronous, live instruction. And with that comes scheduling, timing, but also staffing, optimizing that class size and getting the most in terms of unit economics. Scheduling, in terms of, you can't sell that business while you're sleeping. So I have noticed in deals like that, live instruction kind of businesses, there's not the same buyer appetite. Last year, if I just look at the average deal that I closed last year divided by the recurring revenue, the average deal multiple of my transactions was 12 times. And I had one that was a multiple of several times that, to be honest. So that's against the broader context of we've returned back to 5 to 7x SaaS, kind of ARR kind of M&A environment. So there are outsized deal multiples available for you. But I think, again, having a business model tuned to scalability, to high contribution margins, to an attractive kind of go-to-market, and with that, effective cost of acquisition, I think is absolutely still just as important, if not more so.
And Chris, and I know that you are serving sort of lower end of the market in terms of size of the deals, right? And sort of the maturity of the companies as opposed to some large banks, right, that typically would operate at a much more mature stage. And so I remember as I was building ClassTag, I often heard, hey, before you reach $10 million in revenue, there is really no M&A opportunity out there. Which, is not true, I know now. But what do you think are sort of, I'm not talking acqui-hire examples, but what are the actual M&A profiles, I guess, in terms of scale or strategic value, or what needs to be true generally?
It's hard to say. I think it's so market specific. If you truly have a recurring revenue, SaaS-like business, I sold companies last year that have $500,000 of revenue. But that being said, if you have a business that's, I also have been talking to companies, including on, potential buyers of clients that have 20 times that in revenue. Actually, one of them had, is it 100 million of revenue? And they were sharing that they needed to raise, again, 100 million of revenue. They've already raised a couple 100 million. And they were sharing they needed to maybe even consider doing a deal like the one I was showing them. They had to raise 10 million, and they were raising that on a 2x given the current challenge market. But again, that was a more live instructional type model. So I think, again, just really speaking to the differences in valuations out there based on business model, based on size, as much has been published. You don't need me to opine on this, on the challenges in later stage growth equity, pre-IPO funding or IPO funding. But I think if you have a business that has something proprietary and has a recurring kind of business model, high gross margins, even if on a net basis you're break even or modestly losing, there's probably a buyer for it. And unfortunately, it might come down to calling on 150 buyers and not just calling on them, but having some kind of prior track record relationship where you can get to the decision maker and you're not just just emailing a bunch of info at email addresses hoping someone sees it. So I really think I don't know that there's a really set fast rule if you have an attractive business.
Amazing. Well, I think that's the reality, right? Everyone wants to have a recipe book, but at the end of the day, I think you need to think about repeatability, scalability, building those relationships, right? And thinking about in the landscape, right, of most likely buyers who, potentially really strategically needs you, right? And sort of thinking about doubling down on some of those differentiation that become part of someone's puzzle that make the company very valuable. So I think that's great advice. As someone, Chris, that have seen how M&As blow up, I actually recently looked up a stat before, right? We met. I saw that vast majority of deals in M&A actually don't go through. So I don't know exact stat. I wasn't able to find that, but apparently it's majority, right? So from the time you get an LOI to closing, and that, of course, is devastating because many founders, when they sign that LOI, they just freeze everything, right? They stop, their business activity. They get so distracted. Their teams are distracted, right? So it is a very challenging process to go through and continue to grow your business, which is the most critical and important thing. There has never been a more important time to grow your business than during the diligence process and during the M&A process. But what have you seen? What are the typical mistakes? Why these deals blow up? Why do companies get undervalued?
This past year, every deal closed. Again, I have decade of history with many of the companies, so I think I'm pretty good at taking their pulse. There's one publicly traded K-12 education company where the head of corp dev, he really doesn't really join calls, and if he does, he's probably not even going to turn his camera on. And that business that I just closed last month, I remember he was like, on the call. He was talking about how his because they were also a customer of that business, and he's like, "Hey, we're such big fans of your product." In the end, he wasn't quite sure that they wanted to own the content. He thought maybe they preferred being a client, but I've just never seen that active. So I was able to, things like that related to the
To
client.
gauge the level of interest
The
from
level of interest, engagement. Also, just that deal again when it went through multiple bids from two parties in particular,
right.
and we're going into Christmas, and CEOs are of big, publishing companies that are name brand. What they are literally taking a minute from their Italian holidays with their family over Christmas to. You kind of get a sense that this is a deal that's probably going to close. So, you have things like that. I think, but it is really important, especially earlier on in the process. I remember when I was at Apollo Group, again, we had this joint venture private equity fund focused around the world with Carlyle. And I remember the partner at Carlyle, he told me, he's giving me some advice on, sourcing potential targets. And he says, listen, you love them till you leave them. And I was just like, we're calling on like school owners around the world, some old little French man who owns a high-end business school and, whoever's in the world. And it just kind of rubbed me the wrong way, but that's how the buyers are. And so to this day, I absolutely know certain buyers that will look at everything. Maybe their offers aren't really worth as much because they have, and even in my own experience with one client that when we went to market in 2019, a buyer kind of just disappeared on us literally during diligence. It wasn't even like a deal blew up. There's some finding. They notified us, hey, they literally just let the clock tick out on exclusivity and never actually told us, if they decided something. It was utterly bizarre, but it was a buyer that I had seen that happen before or something like that. So I think you get to, when you know a space and you have those relationships, you kind of know the lay of the land in terms of credibility going into it. And then I think it's just, if you see a lot of deals, if you do a lot of deals, I think you just have a sense of, you can read the temperature but look, it's a careful balance. You want to, especially when you have a smaller business, or it's not a total clear kind of slam dunk kind of fit or exit story. You want to be aspirational about the product launches, where you are in selling, your revenue forecasts. Obviously, with half a mind towards the end, if the deal does close, are some of those forecasts going to be held against you for any kind of earnout, milestone kind of payments? But also in between, after the LOI signed, deals, even in the lower end middle market, they will take 2 months to close. So during that 2 months, if the buyer is going to see a lot of data, and if it's not consistent with what you represented, the deal will blow up. To me, that's the most sensitive thing. Again, just that paired with really understanding that buyer, their history, their reputation, and really taking the pulse of really kind of assessing how it was that they engaged with you through that process, what it took to get that offer, and maybe kind of trying to read the temperature from that. So I guess that's
I can echo that. Obviously my sample size is much smaller than yours, but I think one key element of this is who's really the sponsor, right? So if the sponsor is the CEO of this company, then they will fight for you, right? Even if they are private equity backed and they need to convince their financial sponsors this is a critical part of the strategy, but you have their backing. If it's purely a financial buy, right, and you don't have that strong sponsorship, if something happens even to their own company, which has nothing to do with you, right, purely maybe their quarter close not as well, or the wind of economy blows in a different direction, or whatever that is, right, that really puts you at risk. And I think that's exactly what happened to us in the first M&A that just didn't go anywhere at the very last minute, because we were engaged with private equity and they were really financially minded, and they didn't see truly the strategic rationale without that key sponsor, right? And so I think that's really important.
Yeah, I was trying to look right now. There was a Twitter thread from maybe it's Friday or something, but it was a guy who's whatever influencer, and but he used to work at Google on the M&A team, and he kind of gave a list of M&A best practices, and one of his points was, I think, maybe I'm biased here, but he was actually kind of really dissuading people to going through corp dev, like go through the product. That's not always feasible, especially if you're actually selling the company in a process and you have X months to do it, especially to try to get bids aligned, to get a healthy kind of process with people maybe potentially competing. But he shared, I was trying to look up the number, but I think he said, and again, this is just more his anecdotal experience from being on the buy side of Google, but I think he said 1% of, I guess that probably makes sense if you go to 100 companies to sell, potential buyers to sell a company. I think he said like 1% of corp dev outreach results in a deal. So you're far better off going, again, if timing allows, if business fit, if there's a business rationale, but going to product, going to CEO, whoever you can, versus the typical corp dev M&A person. So I think, again, there's some truth to that. Absolutely.
Yeah, absolutely. And the last and the other piece, I think you mentioned about projections. And I think in our case, right, the diligence took probably around maybe 6 months, 5 months, something like this, from the beginning when we signed the LOI to I think when it eventually closed, a few months. I think it took a few months.
3, maybe.
So, maybe 4 months, something like that. But I think I was so pleased that the projections I gave were really realistic because we beat them.
Especially on the profitability side. There was a moment where I had to like talk you back about like, hey, look how this business is even more profitable than we thought. Should we be selling? Should we be? So
right.
No,
but I think and the other thing related to that, I think buyers generally will always find something they don't like about the business and they want to renegotiate. And I think I've been told, again, I have a small sample that it happens.
I've definitely seen buyers and certain buyers retrade or negotiate, whether out of genuine, real material kind of finding or not. But you had that ace up your sleeve. If they even tried it, you said, "Hey, look, did you see how profitable we are?" Actually, I was meaning to talk to you anyway because I don't want to sell at this price.
That's exactly what I said.
Yeah.
I was I'm so glad you brought it up because I wanted
you brought it up because actually I want to revisit the purchase price too.
Amazing. Well, one question I wanted to ask you, Chris. I know you're increasingly working with a lot of immigrant, international founders, right? Not only serving U.S. market. So I'm curious, how does that change the dynamic?
Yeah, it can. Last year, one of the deals I sold was a Finland-based K-12 science learning company. Finland has such a famous playful inquiry-based pedagogy, which I think, in education, many are aware of. And I think for the buyer, there was a specific appeal that as they came to learn and appreciate that unique pedagogy, and also the opportunity to actually keep that Finnish base for future, including with Finland Ministry of Education support, grants even, to kind of keep it as a center of excellence for research and even more product development. Had the chance to work with, gosh, you're right. You don't think about it, but this is the nature of America. What percentage of our tech founders now are, originally South Asian, East Asian, Eastern European? It's remarkable. We're so lucky to have that talent. And my client base absolutely reflects that. I think, I'd one kind of X generation traditional white WASP kind of founder. Everyone else was first, immigrant or a different ethnicity, and so and in fact, even I remember I didn't intend for this, but I remember when I started investing, I don't know, I think 80-90% of my investments were to, especially in education. We have a lot higher rate of female founders than in the general tech space. But also founders of color. I think literally 80-90% of my portfolio represented one or the two. So Um, I think in terms of immigrant founders, there might be some aspects of selecting the buyer, making sure there's a culture that they want. And I have a story that I don't think I want to share about that, but for sensitivity given current geopolitical. But I had another client that maybe had some sensitivities around cultural fit given their ethnic background and the buyers. But I think maybe to the second part, in terms of international, I'm actually on this call right now from Thailand, and been working with a company here, and they're not known outside of Southeast Asia, not even known probably much outside of Thailand and Vietnam, really, where they operate. And for them, it's not just that everything that goes into a sell side process. It's also introducing to the world. Even how do we now everything is remote, especially after the pandemic, but do they come to that conference with me in April? How do we how would we even think through potential in person? So I think there's always a localization and cultural kind of translation and communication that happens for international companies, and EdTech is absolutely global now. So I've never had I've never leveraged my passport as much for work. In the past it was, hey, I'll just do a little global nomadic work from somewhere warm during a cold Chicago winter. But now this past winter I invested in a company in Singapore that I met at EdTech Asia, working with another Southeast Asian company on the south side. I've been helping a founder with a school, alternative school here. So the space is absolutely global, and with that cultural kind of translation, becomes just part of a deal. Where in the past, so especially when you're again just thinking about selling a Finland-based science pre-K company whose business was dramatically becoming more and more leveraged to the U.S. K-12 market, selling into schools in New York from Finland, and selling to a Houston, Texas-based acquirer. The absolutely required some translation and localization for sure.
Yeah, I remember you were even asking me some questions, I think, related to accounts receivable or something.
For sure, yeah.
Listen, I think it's great, and I think that's the reason why the mission of the Elevator that I recently launched is to help founders grow with confidence in without borders. Because when we talk about software, unless you're in some very few highly regulated areas, there shouldn't be any borders, right? And it's just a matter of either really thinking globally from the get-go or figuring out which parts of your value proposition, for example, really make it for great entry strategy into US, which is, of course, a huge market pretty much for anything and everything.
I just remembered what you're talking about. Right, that Finnish-based company, they were shocked to learn that in the US K-12 system, I don't know what percent, half of all deals, half of all invoices are paid with a paper check. And in the country of Finland, checks became obsolete a decade ago. There literally is no way to deposit a check. There's no way to take a paper check. And so trying to close this deal, and we have to prove that, because otherwise that AR is either it's either AR instead of, which, impacts your net working capital adjustment, which, as you know, always messes up a final deal close. Or maybe they even discredit it as uncollectible AR, or they don't believe us. And then now maybe they're going to discount our revenue. So we were racing around trying to figure out how to collect paper checks, and so yes.
I remember you were messaging me like, Vlada, do they really? What percentage are checked? Like probably half. I mean, that's just the way they do it.
I was also shocked that I'd never realized that before in all my working with K-12 companies. So yes, so things like that will come up because you're right. The world is flat, but there still are local regulations and local cultures that you have to translate.
Right. Absolutely. Well, I just want to end this with great gratitude. I think you founders learned so much about the exit process. And for those of you in K-12 in particular, right, it is a tough route, but someone like Chris is your partner here. And I, Chris, wanted to end with where folks can find you. You sounds like you're active on LinkedIn, going to different conferences. What's the best way to get in touch?
LinkedIn, of course, it's just LinkedIn /Nyren, Nyren. My email. I'm finally, after for the first time in 12 years, I had so many complaints over the years about how bad my website was. It was an original WordPress site I did myself. And so I'm finally relaunching my website here next week, but educatedventures.com. Please, if you hit it this week, don't judge me. I'm sorry. It's not about the website. It's about...
Come back next week and tell me the difference. Which one you like better.
Right. Well, no, you will like the new one better. The old one is horrible. It's cartoon that I did myself 12 years ago. Twitter, wherever. But but in terms of the conferences, we just had South by Southwest EDU, which is one I used to attend. Maybe I'll start again. Certainly if you're in K-12, ISTE, higher ed, EDUCAUSE. But honestly, so much of our domain, so much of our in-persons, it's really about the ASU GSV Summit, Education Summit in April. So I'll be there in San Diego. I'm sure, if anyone, EdTech founders are watching this, they're probably thinking it through too. There's a half off discount code if you're an entrepreneur. You can find it. But see you there or see you online. No problem.
Amazing. Well, thank you so much. And we certainly leveled up to help your startup grow and achieve great success from idea to exit. Thank you, Chris.
Thank you so much again. Thank you, Vlada.